Hey everyone, welcome to this explainer. Look, if you've ever just completely stared blankly at a dense health insurance document and felt a total frustration of trying to optimize your financial risk, you are definitely not alone. Insurance language is basically designed to be opaque, but today we're cutting through the noise. We are conquering insurance math together. Okay, let's dive into this. So, here's our roadmap for today. We'll decode the jargon, map out the sequence of spending, crunch a real medical bill, test your knowledge, and finally look at the true cost of coverage. Basically, a nice, comforting roadmap to lower your anxiety about all this math.
All right, Section 1, Decoding Insurance Jargon. Let's meet the cast of characters we really need to understand long before any sort of disaster strikes.
So, our first term is the deductible. Think of this as the very first hurdle you've got to clear entirely on your own. It's the fixed amount you have to pay out of your own pocket before your insurance company even thinks about pitching in, right? So for instance, if you have a $500 deductible and you file a $2,000 claim, well, you're paying that first $500. Only then will your insurer step in to handle the remaining $1,500. Next up, we have the copay, short for copayment. Now this one's a flat, predictable, fixed dollar amount that you pay for a specific service, completely regardless of the actual total cost of that service. You know, you might see a $30 copay for visiting your primary care doc, or maybe $60 for a specialist. And here's a little insider secret. These fixed fees often apply for routine services before you've even met that deductible we literally just talked about.
Okay, then there's coinsurance. Once you actually clear that deductible hurdle, you aren't completely off the hook. Now, you're basically sharing the bill. Coinsurance is a percentage split between you and the insurance company. A super common split is 80-20. That means the insurer covers 80% of the costs and you cover 20%. So let's say there's a $10,000 remaining balance after your deductible. Your 20% share is $2,000, and your insurer picks up the other $8,000.
Now, what's really interesting about this slide is comparing how these two actually work mechanically. See, the copay is your anchor of predictability. It's a fixed cost. You know exactly what you're going to pay at the front desk, right? Coinsurance, on the other hand, is proportional. Because it's a percentage split, your financial exposure grows exactly as the medical bill grows.
Which brings us to your absolute ultimate safety net, the out-of-pocket maximum, sometimes called the out-of-pocket limit. This is literally the most you will ever have to pay for covered services in a single plan year. If your bills are just piling up and you finally hit this magic number, boom! Your insurance steps in and pays 100% of your covered costs for the rest of the year. This is basically your main protection against catastrophic, life-ruining medical debt.
But you also really need to be aware of the coverage limit. This is the maximum dollar amount your insurance company is actually willing to pay out for a covered loss. If you happen to have a massive claim that exceeds this coverage limit, well, the insurance company simply stops paying and you are entirely responsible for making up the difference. Definitely something to watch out for.
Finally, we arrive at the wait what moment of insurance, the exclusion. Exclusions are specific situations or events that your policy just flat out refuses to cover. This is exactly why reading the fine print matters so much, guys. Common exclusions might include things like cosmetic procedures, intentional self-harm, or sometimes certain pre-existing conditions in non-health policies. If it's excluded, you're paying 100% of it, starting from $1.
All right, moving on to Section 2, the sequence of spending. Now that we've got the vocabulary down, let's look at the chronological reality of how these terms are actually applied when disaster strikes.
Let's move to and see how this builds into a practical three-step sequence. When you get a massive bill, here is the exact order of operations. Step 1, you pay 100% of the costs until you hit that deductible. Step 2, coinsurance kicks in, meaning you and the insurer split the remaining costs by percentage. And Step 3, your out-of-pocket max caps your total spending. Once your deductible and coinsurance payments add up to that max, the insurer takes over completely.
Section 3, Crunching a Medical Bill. Let's take a genuinely terrifying real-world scenario and watch this sequence shrink a massive hospital bill down to size.
Okay, here's our scenario. Imagine you find yourself hospitalized, and the final bill is a staggering $15,000. Ouch. Now, your health plan has the following specifics: a $500 deductible, a 20% coinsurance rate, and a $3,000 out-of-pocket maximum. Keep those exact numbers in mind because we're going to run them through our sequence right now. All right, Step 1, you tackle that $500 deductible up front, which brings the remaining bill down to $14,500. Step 2, coinsurance kicks in.
You owe 20% of that remaining balance, which comes out to $2,900, while your insurer picks up the big chunk, $11,600. So, if we add your deductible and your coinsurance together, your calculated out-of-pocket total right now is sitting at $3,400.
But wait, so the crucial point is, your out-of-pocket maximum is $3,000. Your calculated total of $3,400 actually exceeds your safety net. Therefore, you do not pay $3,400. You literally stop paying the absolute second you hit $3,000. That out-of-pocket maximum just saved you $400.
So, when the dust finally settles on that $15,000 hospital visit, here's your final breakdown. You pay exactly $3,000, perfectly hitting your out-of-pocket max. Your insurer covers the rest, the full $12,000 difference. You know, truly understanding this math changes absolutely everything about how you view your financial risk.
Section 4. Testing your knowledge. We've gone through it together, and now it's time for an interactive checkpoint. Let's see if you can apply the blueprint we just learned.
All right, here is your challenge. You receive a covered medical bill for $10,000. Your specific plan has a $1,000 deductible, a 20% coinsurance requirement, and a $4,000 out-of-pocket maximum. Think about our 3 steps. What is the actual final amount you're going to pay out of your own pocket here?
Okay, let's break it down together. First, your $1,000 deductible leaves $9,000 on the bill. Next, your 20% coinsurance on that remaining $9,000 comes out to $1,800. Add those two together, and your total out-of-pocket paid is $2,800. Now, because $2,800 is safely below your $4,000 cap, you pay exactly that, and the insurer covers the remaining $7,200. Make sense?
Section 5. The true cost of coverage. Now that we've totally mastered the event of an emergency, let's pull back. We need to look at the big picture of what you're paying every single month versus your annual reality.
So insurance premiums are almost always quoted to us on a monthly basis, right? It makes them look a lot more manageable. But your risk isn't monthly, it's annual. If a health insurance plan costs $180 a month, that means you're paying $2,160 a year. And here's the kicker. That $2,160 is what you pay even if you never get sick, never go to the doctor, and never file a single claim. It's simply the baseline cost of having that protection available to you.
And this brilliantly illustrates how you really need to evaluate and choose between insurance plans. Always convert everything to an annual basis. Take the annual premium you're guaranteed to pay and add your realistic expected out-of-pocket costs. A plan with a super cheap monthly premium but a sky-high deductible? Yeah, that might actually end up costing you significantly more in a bad year when you need serious medical care.
Which leads us to the ultimate question you really have to ask yourself when looking at your own policies. Are you overpaying for coverage you simply don't need? Or are you sitting on a really cheap policy, risking catastrophic out-of-pocket costs that you realistically just can't afford? The math holds the answer. Take a look at your own numbers today. Thanks so much for joining me on this explainer, and keep learning.